Fernando, I don't have a great answer to your question. You said, what is the relationship between implied volatility and the moneyness? The IV has more impact on the OTM option than ITM options. Well, changes in implied volatility probably will, but it's not so much because of the fact that it's further, well, it kind of is, but what I'm trying to say here is that it's more related to the fact that you're out of the money call. Let's just start with calls. Okay, Fernando, let's just start with calls. Your out of the money calls have a lower premium anyway. All right, so here, this deep out of the money 45 call has a higher implied volatility of 0.774. Okay, let me go to the Black-Scholes calculator. Let's get this volatility up to where we saw. This is for that deep out of the money 45 strike that had a midpoint price of, about 28 cents or so. Okay, so we were looking at 7449. Is that right? 7449 is the implied volatility. Our expected call premium, where we're at, 17 cents. Bid of 5, ask of 35. So there we are. Now, if there's a subtle change here and it goes up to 0.80, sorry, Fernando, and this goes up to 0.80, what are we going to expect to see? Yeah. That premium went up 7 cents, or almost 50%. It's not so much that the implied volatility had more of an effect on it. In this sense, it's because you start off with such a low premium that any change in implied volatility is going to make it look like your option went up 50%, 60%. Or if it drops, if it went down to 0.55, we'd expect the 17 cent midpoint, of course, in that case, to probably drop down to, I don't know, let's say say 0.10, 10 cents. Let's check it. Oh, wow. I was way off. Drops down to 3 cents. It's just like saying, why does a 5% movement have such, or a 10% movement look so much smaller on a $1 stock than it does on a $100 stock? And it's still 10%. It's just because the moneyness you started out with, the money value of what you started out with the out of the money options, Fernando, is so much lower. Okay, so any subtle change in volatility is going to make it look like it moved 20 cents, 25, 30, 35 or more percent, but you really only moved 7 cents, 8 cents. Okay, so let's take the at the money. Let's take that 37.50. Okay, and this is just using the calculator. You can do this on your own time for now. You can play around with this tool and put in the numbers and see what your out of the money or in the monies would change. So at a volatility of 0.55, we expect the at the money option to be valued at about $1. And we go up to 0.75, where we saw our out of the money 45 strike current implied volatility. And this goes up to 157. Okay, so it also gained 50% by that movement. 20% change in 20-point change in volatility would jump this up 50%. We started at 101. Here it is at 157. We started off with 17 cents with the volatility, and then we increased it to 0.8, and it moved 50%, didn't it? Moved up to 24 cents. Let's go up to that 0.85 again. Is that what we did, 0.85, or was it 0.80? I think it was 0.80. Okay? And we started out at 101. We saw the movement from 55% volatility to 75, and that was a 50% gain. We see a 5% movement, or 5-point movement in volatility from 75 to 80, and we move from 151, or 155 to 171. So we gained 20 to 30 cents. Doesn't seem a lot percentage-wise now, does it? But at the same time, that other one we saw almost double, and it's because we started off so low. That's how volatility affects the deeper out of the money options. You're seeing price movements that are equal, but it's more of a percentage, but you started out so low as well. Okay, so play around with that tool. Run your numbers on some of your chains and what your implied volatilities were, and what would if the implied volatilities increased by 50%, what do you expect your option to gain by as well? Okay, Octavio, we covered this last week. I don't know if you remember it, or if you were online when we talked about it. It wasn't related to your question. It was, I lose all those papers. I can't remember whose question it was. It might have just been posted today. I forget. And anyway, Octavio's direct question is, I'm looking to sell a naked put on CMG, probability 79 to 80, very small window. And Thinkorswim is showing that to be the 990 and 995. Is the filter and power options different? And the answer is subtly yes. Okay? And I can't remember who asked the question last week, but this same question came in last week. It wasn't Fernando. It was, I can't remember who it was. I'm looking over my notes very, very quickly. I don't think it was Sudhakar. Let me just skip it. I'm not going to find it in my notes. I don't remember everything that was posted. Okay. I'm going to go quote. So here's the thing. Last week or 2 weeks ago, there was a discussion on, it was the delta and something else. But the question was, why is the delta on Thinkorswim different than what I'm seeing on PowerOptions? Okay. Delta, just like probability, takes into account, to calculate the delta, to calculate the probability, is very similar to the 5 factors that are used in the Black-Scholes pricing model. The stock price, okay? Days remaining to expiration. Strike price of the option, whether it's in the money, whether it's out of the money, as sort of Fernando was just talking about. The current free market interest rates on the market, and then, of course, the volatility. Now, it's not directly the same, but how the Black-Scholes pricing model is calculated is you plug in these 5 factors into an equation, and it spits out your value, the theoretical value of the option. Now, implied volatility, how's that factored? You plug in the actual price of the option on this side of the equation and work the equation backwards to solve for volatility. And the difference, whether the actual trading price is higher or lower than the theoretical value, gives you the implied volatility. What is the volatility being implied by the actual trading price of the option? Probability is based on sort of, the 52-week trading range of the stock and applying the volatility values of that with getting a standard deviation of those values to sort of get at the range. Okay? Now, it's a little bit different with probability. Delta, I should have said, is done to say, well, look, let me go back to delta first before I talk about probability. Delta is looking at, well, look, if this actual price goes up, if this stock price goes up 1 point, let's work the equation again to see what the value of the option should be, and that's the delta. Okay, how much did it increase? If we put the stock up $1, what is the new value of our call or put? And that gives us the delta. It's sort of based on these 5 factors. The stock price is unchangeable, but you can change it to calculate delta, of course. Days to expiration, not changeable. Strike price, written in stone. Current interest rates, don't really fluctuate, they're there. This is the factor that can change. There's no one rule of thumb, Octavio, that says that every person should be using, every calculation should be using the 20-day, the 50-day, the 100-day, or the 250-day volatility in that first equation to get the Black-Scholes value, which then is used to determine implied volatility by working it backwards. We use the 50-day volatility in those calculations and those determinations. Black-Scholes pricing model, other things of that nature as well. I don't know what Thinkorswim uses. I don't know if they're using 250. I don't know if they're using 100. I don't know if they're using 20. Okay? The probability is very similar to this in the fact that you look at the past trading range of the stock and you take the standard deviation of those values to apply a bell curve, which tells you where is the probability. How can this change? Well, if we're using a 52-week trading range and they're only using 26 or they're using 104, that could be the difference. We feel confident using this probability equation. It's the same one that Macmillan talks about in options as a strategic investment. The Black-Scholes model and the value, the 50-day, I'm pretty sure is the same one that Larry Macmillan discusses in the options as a strategic investment. So that's what we use here in PowerOptions, but that's why you see the difference sometimes between different services. You just have to know which volatility they're using. Again, I know we're using the 50-day for those equations, and we're using the 52-week trading range to calculate the probability with that one standard deviation. They're using a different time frame, that's going to give you the difference. Neither one of us are wrong. You just want to know what the values are that they're using. We're using the 52-week trading range and the 50-day volatility for those delta and Black-Scholes pricing models as well. Okay? Okay, funny on that one, Octavio, I'm sorry. Later on down the line here, about 10 minutes ago, you said to clear the question, I have PowerOp filter set up 79 to 82, and CMG is on part of my recommended list. Okay, are you doing a weekly? This will answer Ed's question as well. Naked put, search. Follow up to this. Let's see here. Let me clear the filters. I think you were doing weekly. I think you did say weekly. Okay. You're doing the strict probability here. 79 to 80. Okay. Am I in naked put? Yes, I am. I always look for it on the other side. 79 to 82. Doesn't matter the range out of the money, it's already taken care of. I'm going to look for some option volume today at open interest greater than 0. I don't care about the return. What I do care about is CMG. All right. Yep, I have the 10-10. That's 1 week out. The 10-10 is 1 week out. Okay, so the June 12th 10-10 strike, delta of 0.17, probability of 82%. You're at the 900 level. And again, that's I answered that question. It's because of the volatility that they're using for those calculations for delta and the time frame they decided to use to the probability. I know what we're using. I have no clue what they're using. That's the only way I can answer. I don't think we're wrong. We follow the same equations that's used in that Larry McMillan book. That's where we sort of adapt from. We worked with Larry McMillan extensively for years and years. But that's the 10-10 strike. That's what I have. Okay, 79 to 82%. I'd say that you're, on our calculations, what did you mention, 990 or 995? It's probably a 96 to a 99% probability. And 70. The 990 didn't come up. I wonder why. Maybe it's, wow, is that possible? Maybe it didn't have any option volume today. Maybe the 990 or 995 didn't trade today. It seems unlikely. All right, well, let's just do this, and I'll just go to the weekly anyway. Let's go to option chain. 990 put, oh, 0 bid. That's probably why it didn't show up. No, but the other showed up. Okay, that's not a good answer. I'm sure here. Black-Scholes, delta, 0 delta. Okay. Okay, I think I see the problem. I'm going to take a look at that. It's weird. It shows volume and open interest, but it has a 0 delta in the calculation for the 990 and the 995. That's probably why, even though the probability is 99.9%, that's what we have in that equation there, with a stock at 10.55 for 8 days to trade. Okay. Now, sorry. Ed, you said, can you use the tools to scan for IV rank or IV percentile? What we prefer to screen by. Okay, TOS uses 252 for implied volatility, Octavio. So that's one of the reasons why you see a difference in delta and other equations. TOS is using the 250-day for IV. For volatility, we're using the 50. Okay? All right. Okay, so let me just clear this out. By week 19, I think you mean June 19th. I'll get to you in a second, Ed. I'm sorry. That's just to fill up Octavia's question. Yeah, 935, 930, 920, 925, 915. And going back to our chain here. Oh, that was this week. That's what you meant. Okay, so if I go to the 19th. Okay, so the 990 for that 1 week out. I'm sorry. Yeah, delta of 0.9, probability of 91. That's what we have for the 990, and 89.2 for the 950. And for June 19th, Octavio, there you go. Okay, 82.9% probability on the 990, 80.9 on the 995 for the 19th expiration. Ed, my apologies there. You asked, can we search by IV rank and IV percentile? We prefer to use what's called the percent implied volatility range. The percent implied volatility range shows you where is the option's implied volatility right now compared to where it has been over the life of the option. Ernie and I feel this is a much better representation of the actual strike you're analyzing on the position. Okay, so based on market conditions, where has it gone? What is the implied volatility range of that particular option? Not over the year. All right, one of those two, I can't remember if it's IV rank or IV percentile, they talk about the volatility of the stock over the course of the year. We're looking at the actual implied volatility of the option since it was released in the market. Where is it now compared to what has been since it existed personally? I feel like that's a better measure of trying to gauge the actual single strike of the option rather than looking over a year time when market conditions a year ago are completely different than the market conditions today. This is what we prefer to use, and that's what's available in PowerOptions. Still very useful and very powerful. So if I'm searching for naked puts and I only want to see put options generating premium that are near the high of their implied volatility, say 85th percentile of their entire implied volatility range, I'll just plug that in. And because of my other criteria, oh, let me take CMG out now that we're done with that discussion. CMG doesn't have a high implied volatility range. There we go. And you see things you'd expect to see. Biopharmaceuticals, one of the ETFs for a Brazilian company. There's another one as well, because Brazil's dealing with a lot of stuff that we were sort of dealing with. The 3 times Japan Bull hurts. Oh, right, because they're nearing bankruptcy. I forgot about that. They're thinking about filing for bankruptcy, so that's why they're coming up with a high percent implied volatility range. And in addition, of course, to being able to see that, in the add remove columns, you can choose to see the percent IV range and the actual range of implied volatility. Another way to see that is we can just go to the research tool and option research. This is a fun tool, Ed. So what this tool shows you is all the data we have on that particular option. Over here, of course, I've got my current implied volatility, 698%. Since this option has been released, the IV has gone from 229% to 745%. So yeah, we're in the 98th percentile of its true range. Now, this is a weekly, so down below we see this only been available for a small amount of time, all right? Since about May 10th or so is when this option that came up on our search, this 3 weeks away to expiration, was released as a weekly. But you can see here that you can scroll through and you can see the implied volatility versus the option bid, or if you want to see delta versus implied volatility since the option has been released. A better one to maybe look at is, yeah, perfect. I'm going to take that January 40 we were looking at as a married put, Ed. I'm going to go to research and option research because we know this has been around for many days. So the IV range currently right now, it's at 0.3861. It's at 72 percentile. It did have a 0 range at one point. But then you see all the way back to when it was released on the market to September, option bid versus implied volatility. And we can sort of, click and drag on this a little bit to give us zoom in sort of and zoom out. And then I can choose to compare delta versus IV and a lot more as well. But for that particular answer, Ed, we have the percent implied volatility range, which is similar, of course, to the IV percentile, I believe. And that's what we choose to use on PowerOptions. Where is the implied volatility of an option now compared to where it has been over the life of the option? And it's available in most of the search tools as well. And if you've got a spread, you can sometimes screen by the implied volatility range of the short option and the implied volatility range of the long option as well. But covered calls, naked puts, you can screen, and other strategies, married puts, long calls, long put straddles, you can screen by that percent implied volatility range. All right, well, ladies and gentlemen, I think that cleared out the queue of our questions that we had for this June 5th evening and Friday session. I just, of course, want to thank everyone for joining us. And, of course, I want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk, as we saw today. We saw ways to defend against some of that risk and more, but it may not be suitable for all investors. Now, when we saw some of the various tools today on PowerOptions, the portfolio tools in the beginning for our discussions for Larry, VOW Play, and Terry, looking at position analysis and rollout opportunities. We looked at the search tools for various strategies as well. And of course, you saw some other tools there. The Black-Scholes calculator we just reviewed for Fernando, and that options research tool where you can compare those different options qualities against one another on that graph form. So if any of those appeal to you and you want to get going and you haven't done so yet, just go over to powerop.com, put in your name and email address, no credit card needed. You'll have full access to PowerOptions for 14 days. Of course, after that, the monthly subscription starts at only $45 per month for the end-of-day service. 20-minute delayed service is pretty much the most popular subscription level at $65 per month. We do offer full historical backtesting services. That's $100. That includes the delayed service. It's just $35 more to get access to the backtesting tools and the historical chains. Then, of course, we do offer the real-time service as well. Now, we didn't talk much today about existing webinars, but we mentioned we had some discussions as previously last week. Remember, you can check out our archived webinars page at any time. It's powerop.com/webinars.asp. You can also check us out on YouTube. There's many videos that are posted on YouTube that we don't necessarily post on PowerOptions. They may be duplicates or other things, but there's a lot of information on there as well. So it's just go to YouTube, search for PowerOptions. You can always check the blog.poweropt.com. Now, if you think of any questions, of course, over the weekend, I'm going to try to get in for some of these, get that first section of 34 minutes posted from Larry and for VOW and Terry so they can do some analysis, but I'm going to try to get the other ones done by the end of the weekend as well. Send us an email at any time, support@powerop.com or support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. Trial members and subscribers can schedule a coaching session at any time. That's usually a 35 to 45-minute coaching session with Ernie or myself. We'll walk you through the tools on the site, kind of like we did today, but it's just you and us on the phone and so forth as well. All right. All right. Okay, let's see this comment here. Chuck says, if Jim Allen and I come for a visit, can you score some soft-shelled crabs? Yeah. Here in Delaware, we're an hour and a half away from Lewis, Delaware, where I typically vacation with my family in August. It's on the other side, right at the end of the Delaware Bay there, right before the ocean. But, of course, right behind us, we've got all of Maryland and the Chesapeake, where we get a lot of our crabs from as well. So, yes, we can find some soft-shell crabs for you there, Chuck, and beer is optional. That's okay. I've got mine going right now. Started off with a little one tonight, the Left Hand Nitro Milk Stout for this evening's presentation. Of course, I only had 2 sips of it, but you know, that's the case there as well. So I'll look forward to seeing that, Chuck. If you and Jim Allen come out here, let us know if you come across there, across the pond and across the way from down under to the up under, I guess, or the up over, we'll call it. If you guys make it out to the East Coast from down under, we'd love to see you. Ladies and gentlemen, thank you again. Have a fantastic weekend. Take some time for yourself. De-stress a little bit. I know there's a lot going on in everyone's mind about things that we've seen happening, so take some time to yourself. Stay mentally strong so that come Monday, whatever the market throws at us, we're going to be able to handle it and take our positions and be able to control our positions as well. We'll see you all soon, everyone. Good night.